Okay, so we're going to start with a broad overview of derivative instruments. For the first few lessons, our objective will be to understand how derivatives are defined, why they exist in the first place, and the role that they play within financial markets. We'll also spend some time describing those financial markets in which derivatives are traded. Broadly defined, a derivative is a financial instrument that has a value determined by the price of some other kind of asset or security. In other words, it derives its value from something else. A simple example is shown on this slide. Let's say that you find a trading partner who is willing to enter into a contract that has a value which depends on the future price of a commodity, in this case, corn. If the price of corn in 1 year is greater than $3 per bushel, you'll receive $1. If the price is less than $3 per bushel, you'll pay $1. Okay, very simple. There's one variable here, the price of corn 1 year from now. And there's only one security changing hands, which is the single dollar that will be paid from one party to the other. So you may be asking, why would someone want to enter into this kind of contract? Well, maybe you want to speculate on the price of corn. You see a coming boom in the corn market driving demand. Maybe Taco Bell is introducing a new taco that will be a killer new product. Or maybe on the other side, you foresee a drought that leads to a lack of supply. What if you're a corn farmer? Maybe you'd be willing to enter into a contract that protects you in case the price of corn plummets. You might be willing to be the counterparty to this contract. If the price is high, you're fine with paying that dollar. But if it's low, you need that dollar to supplement your income. So from the perspective of the farmer, this contract might be a risk management tool. From the perspective of the speculator, it's a money-making tool. Any kind of derivative security could be used for speculation, for risk management, or for both at the same time. The financial securities are traded all day, every day. But how does this actually happen? Well, any trade involves the following steps. First, you have to have two counterparties who are willing to make a trade. You may want to buy 1,000 shares of GM stock, but if there isn't someone willing to sell you those shares, you're out of luck. And if you want to pay something like 50% of the market price, you're unlikely to find a seller. The two parties need to agree on the terms of the trade, including the price of each security involved. Next, the trade must be cleared. This means that the terms of the trade are spelled out, including what each party is obliged to do in order to complete the trade. Sometimes, if the trade involves a security to be delivered at a later date, a party to the trade might be required to post collateral to ensure that the counterparty will be compensated if the agreed upon security cannot actually be delivered for some reason. The trade must then be settled. This step occurs when all securities involved in the trade have changed hands, and all terms of the trade have been successfully completed. Finally, if necessary, ownership records are updated to reflect the trade. For example, if you buy shares of stock in a company, either the company or a custodian will record your name as a new co-owner of the company. Now, this may seem like a cumbersome process. Who has time to draft contracts, define collateral, and verify that all parties have fulfilled their obligations? And how can you guarantee that you'll be able to find a trading partner in an actual physical market? Fortunately, the need to automate these processes have led to the creation of electronic exchanges, allowing traders to find each other in the virtual world and use standardized processes to conduct their trades. The New York Stock Exchange is the most famous exchange here in the US, but there are many, many exchanges worldwide. Some are specialized exchanges focusing on a certain type of security, such as commodities, while some handle multiple types of securities. But the exchange also takes on another important role, especially with respect to derivative securities. It acts as a market maker, facilitating trades even if counterparties don't readily exist. The exchange will buy and sell securities itself to maintain trade liquidity and to serve as a reliable counterparty for any transaction, thereby reducing risk for the buyers and sellers and ensuring a smooth flow of securities through the marketplace. Of course, there are plenty of trades that occur without involving organized exchanges. These are called over-the-counter or OTC trades and generally involve a more manual process. Given that there are so many special organized exchanges, why would you want the additional hassle of trading OTC, over the counter? One reason might be that you're not interested in having your trades observed by the public or subject to government regulatory oversight. Perhaps you want an element of privacy, or perhaps there's some kind of legal gray area that you want to choose to operate in. This doesn't mean that all OTC trading is nefarious by any means. For some securities, the OTC market is simply more robust and efficient than the organized exchanges. On this slide, we discuss some measures of the trading activity in any given market. First, we have trading volume. This is simply the number of securities or financial claims that change hands over any given time period. For example, the average daily trading volume of the New York Stock Exchange is 2 to 3 million trades involving 2 to 6 billion shares of stock. The market value of the market is the total value of the securities or claims that could be traded. Typically, you'd see this expressed in terms of the market value of a company, which would be the sum of total price of all of its outstanding shares of stock. This is often referred to as the market capitalization, or market cap. The total market value of companies traded on the New York Stock Exchange is about $30 trillion. The notional value is the value of some kind of position in a security or claim. For example, if you hold a contract that gives you the right to buy 100 shares of stock for $100 per share, the notional value of your position is $10,000. The market value of your position, in contrast, is the price for which you could sell that contract, which would depend on the price of the stock at the time. If the underlying stock price was only $80 per share, then a contract that allows you to buy shares at $100 per share might not be worth very much at all, since you could just go to the open market and buy shares at $80. If the underlying stock price jumps to $120 per share, then the contract becomes much more valuable. But that $10,000 notional value remains the same in all cases. Finally, the open interest is the total number of contracts that remain to be settled for a given party. Essentially, it's a measure of your exposure. In the example above, if the right to buy 100 shares of stock is the only contract that you have going, then your open interest can be expressed as one contract or 100 shares of stock. In addition to facilitating trading and record keeping, financial markets play an important role in risk management. Managing risk is quite simply a critical part of life in modern society. Traditionally, businesses and individuals have looked to the insurance market to mitigate risk. This is the reason that you buy car insurance or health insurance. You're willing to pay a relatively small ongoing amount to protect against a catastrophic financial loss. Of course, we can argue about the relatively small cost of insurance policies, right? Some communities also establish risk-sharing funds or associations to help each other in the case of financial ruin. Financial markets provide yet another way to manage risks. By matching up buyers and sellers and thus facilitating trades, the market allows individuals and businesses to transfer risks to other parties who are willing to assume it, perhaps because they have offsetting risks or they are speculators looking for an investment return. If a risk can be diversified through security trading, the market provides the mechanism to get it done. The remaining risks can be held by those who are most willing to hold them. Now that we've established some basic facts about financial markets, let's talk about derivative securities. First, a fundamental question: why do they even exist? There are a couple answers to that question, and they involve the same speculation versus risk management dichotomy that we discussed when introducing derivatives. The basic reason that derivatives were created was to respond to a desire to manage risks. There were several key events in the late 20th century that led to an explosion in both the types of derivatives and their trading volumes. And each of these events involved some kind of increase in price risk that needed to be managed. In the early 1970s, for example, the gold standard was officially abandoned around the world, which meant that currency values were no longer fixed in relation to gold or to each other. Prior to this time, the exchange rate between, say, US dollars and British pounds was relatively fixed and reliable. It changed over time, but those changes were largely set by law. A US company doing business in the UK could be relatively sure that each pound that they earned in the UK could be exchanged for a certain number of dollars. Say in 1970, this was about $2.40 per pound. Once currencies were permitted to fluctuate, the US company no longer had this certainty. A pound might be worth $2.50, it might be worth $1.50, depending on economic conditions in each country. So companies now had an interest in locking in exchange rates, and they accomplished this by trading in new currency futures contracts offered by the Chicago Mercantile Exchange. We'll talk much more about futures contracts later in the course. Volatility similar to that in the currency market was introduced into other securities as well. This slide lists a few of the more significant events creating that volatility in the oil, bond, natural gas, and electricity markets. Financial derivatives for each of these securities soon came into widespread use. The charts on this slide illustrate the significant increase in price volatility due to OPEC activity in the case of oil and due to abandonment of the gold standard in the case of currency exchange rates. What was once fairly stable suddenly became extremely difficult to predict. And this lack of certainty led to an explosion in the trading volume of derivative securities. The chart here shows the exponential growth in trading volume for exchange-traded derivatives. You can see that there was almost zero activity before all the deregulation events in the 1970s, steadily growing until about 2000, and then skyrocketing after 2000 as new types of derivatives emerged. Similar growth occurred in the over-the-counter markets, but that data is a little more difficult to come by due to the lack of regulation. So we've talked quite a bit about risk management, which is the main driver for the creation and use of derivatives. But we can't discount the other side, speculation. Investors are willing to take on some level of risk in order to generate investment return that is higher than a relatively safe investment, such as a treasury bond. Derivatives allow for investors to take on risk and the potential upside return in an efficient manner. Derivatives can also be used as a way to reduce transaction costs. Let's say that you want to have exposure to 100 shares of a certain stock. You could buy the stock outright, or you could enter into a derivative contract that provides you with the right to buy those 100 shares at some point in the future. Oftentimes, this is a much lower cost way of achieving the same position. Sometimes derivatives can be used to achieve regulatory arbitrage, which is another way of saying getting around the rules. For example, let's say that you own shares of stock in a company. You want to sell some of those shares for financial reasons, but you want to retain the voting rights that come with those shares of stock. In this case, you can use derivatives to achieve the financial result that you're looking for, while continuing to own the stock and thus maintaining your voting rights. Another example is that tax treatment of capital gains can differ from the tax treatment of dividends or bond interest. You can use derivatives to create synthetic securities, which we'll talk about at length, to achieve the economic return of one security and the tax treatment of another. For example, you can create a portfolio of stocks and derivatives that it acts exactly like a bond, but is taxed like stocks. Finally, derivatives can be used to achieve financial arbitrage. The theory of efficient markets tells us that in a market where there is sufficient amount of trading activity, all securities should be priced fairly. That is to say that if two securities have the same economic characteristics, for example, they produce the exact same expected cash flows in the future, then their price should be exactly the same. You can't buy one of these securities and then turn around and sell it immediately for a higher price, essentially getting a positive return at no risk. The concept of getting a positive return at no risk is called financial arbitrage, or just arbitrage, and it will be a central theme in this course. In cases where markets aren't perfectly efficient and arbitrage opportunities can be identified, derivatives often allow you to take advantage of those opportunities quickly and easily. In the real world, arbitrage opportunities are quickly rectified by the market, or else some lucky investor could theoretically make unlimited risk-free profits. As more uses for derivatives emerge, the demand for different types of derivatives drives innovation. This has led to the creation of roles devoted to designing new and innovative derivatives and other types of securities. This is the field of financial engineering. Often, the new types of securities are a boon for investors and risk managers. They allow for easier and more efficient ways to achieve their objectives, be it speculation or hedging risks. But because regulation of these new types of securities is often a step behind, there's an element of danger involved. The highest profile example is probably the collapse of the real estate market in 2007 and 2008, which led to the 2008 financial crisis. This collapse was facilitated by new derivative securities based on mortgage loans. Investors would bundle these loans together and sell them as mortgage-backed securities or collateralized debt obligations, which quickly lost value as overextended homeowners defaulted on their mortgages. Since these new derivative securities were so highly leveraged, meaning that the risk was multiplied, the market couldn't react quickly enough to the loss in value, and panicking investors dumped these securities on the market, leading to further devaluation and ultimately a collapse. There were some winners, including investors who used newly created credit default swaps to bet against these mortgages. The story of these events is told in the book and movie The Big Short, which I highly recommend if you haven't seen it.